The lesson of the story, though, is there is a tax on wealth for those that go into a financial advisor and say, I'm scared of losing money.
Thank you for checking out Real Talk Personal Finance. Shit's about to get real. Cash Flow King with you today. And in today's episode, we have a first-time, very special guest, Jessica Perrone from HerFinIQ. Before we have her come on the show, just a couple of quick announcements. There are a couple of shows that are launching here in Q2 of 2026, depending on the time that you're listening to this. I already made this announcement way back in our newsletter for our premium subscribers.
Premium!
But for those that may be just catching the normal episodes, just wanted to remind everybody that there is a fan mail feature in your show notes. So, for example, if you listen to the podcast on Apple Podcast and you click on fan mail, not only can you text the show as you always have been able to, but they've added a new feature now where you can actually leave a voicemail, and it will allow you to record up to a 1-minute voicemail. You can feel free to send that into the show. That could be comments, that could be questions, any sort of feedback you may have. And if you're so lucky, we might just pick yours and play it on an upcoming show. With that said, and without further ado, let's get into today's episode. Jessica, thank you for taking the time to come on the Real Talk Personal Finance podcast. Welcome.
Thank you so much, and thank you for having me. I'm so excited for this.
Yeah, this should be really, really cool. So for the listeners, I guess give us a little bit about your background and tell us a little bit about how that branched out into HerFinIQ and what that's all about.
Well, thank you for this opportunity. Well, I started my journey as really not a finance person and not really identifying as a finance person. I started off the oldest of 8 children. My mom was an immigrant, and frankly, there wasn't any money conversations because there just wasn't any money. And over my career, I had a lot of amazing mentors. And later in my career, found myself with my ex-husband launching a fintech company, of all things. And it was such an amazing experience because it sort of translated into my own personal finances at that point in time. I had gotten all my finances in a row. I had paid off all my bad debt. And I was like, you know what? I really want to be taking advantage of this thing called the stock market, right? All these guys around me are trading and making a ton of money. I want to do this too. And so launching a fintech company where I was working with a lot of traders, I was like, you know what? I'm going to learn how to trade. I'm going to actually try this and try to manage my own money. And that's sort of how this whole Her Financial IQ journey started. It was me growing up financially and on this journey, finding out that, man, oh man, was it hard to really figure out how to start investing. And that's what I set off doing. And that's what I've been doing for the last 6 years, is building a curriculum that makes personal finance and investing approachable and fun. I know it's hard to have both those words in one sentence, but yeah, fun and approachable.
Yeah, I actually, and we'll put a link to this in the show notes. I downloaded for anybody that knows me knows I love to laminate everything. Ever since I bought a laminator, I laminate everything. So I'm holding up, you can't see it because we're on audio only here, but I'm holding up your Reveal Your Investing IQ quiz by Jessica Perrone, and it's laminated. And it is kind of, interesting, I think, because like you just said, I think this will resonate with people where money maybe is not their cup of tea, and this is just like, it almost feels like a chore maybe for them to like, oh my goodness, now I need to learn about money, I need to do this, I need to do that. But just really quick here, you crack me up. The first question on this Investing IQ quiz, your APR is, and there's multiple choices, and the first one I started laughing, similar to CPR but starts with an A, right? So I think this is very funny, it's very fun, it's very approachable, and it seems like the content is easily digestible or would be easily digestible by others. So that's pretty cool there. You also have, I noticed, the AFC credential, which I believe is accredited financial counselor. Can you talk to us a little bit about what that entails and what made you get that and how are you using that today?
Yeah, absolutely. Thank you for that. So I had when I created my courses, I created them investing forward. So my first course I created was Investing for Beginners, which kind of talked about the different types of accounts that you can choose to start your investing journey, which I found that there really wasn't a great sort of like overview of. Like every financial firm out there wants you to buy their product, so there really isn't like an overview of all the different financial products out there and how they apply to you in your life stage and the goals that you're trying to reach. So I created the Investing for Beginners, and then I created my Stocks and ETF Simplified course, because once you sort of figure out the type of account you want to invest in, you kind of have to understand what you are investing into. And so I know that your question was about the AFC accreditation, but what I found in those courses, what I had a lot of women doing was coming to me with credit card debt, trying to invest their way out of credit card debt.
Yep.
And that's when I created my Before Investing course, which was basically everything I did without intentionally knowing it to build that surplus and get investing. And that is paying down your bad debt. That's budgeting, that's savings, that's an emergency fund, and that's building your credit score. Because believe it or not, you're wasting money if you don't have a good credit score. It just increased the cost of borrowing. So with that, I felt that my knowledge base was so heavy investing, I really wanted to get down and dirty in the personal finance side of things and really see the emotion side, the methodology side of a financial coach and counselor. And I feel like this has really helped in everything I do, and it really allows me to see a person holistically from soup to nuts. And it's just a really rewarding accreditation to have, to be able to take a individual, really identify where they're coming from and have the full path for them. And that really is super rewarding.
Yeah, I think that's very important. I'm just going to kind of interject here. You know, I had a client, this is actually, believe it or not, yesterday, who came in, new client to us, and she was getting started or trying to get started with her retirement plan at work. And we got to talking a little bit about her situation, and I won't name the name of the other company, but she started telling me about, yeah, I met with so-and-so, and this was about, I think, a dozen years ago, and they made me start this account, this account, this account. And oh, by the way, I'm single, no kids, no dependents, and they set me up with this life insurance plan and da-da-da-da-da. And she kind of just seemingly haphazardly opened up these different accounts at the recommendation of this quote-unquote advisor who basically had her put money in different places, and she had no understanding of why. And so I think it's just so important to really go back to basics and understand the fundamentals of what are we doing, why are we doing it, and then to your point earlier, why does this specifically make sense for my situation, right?
And I love that you brought up that example, because it's a situation I see over and over and over again. And a lot of it stems from the fear of money conversations, and also insecurities like, oh, I'm not smart enough, or I'm not a money person, so I can't understand these things. And what I really love to just reinforce with my community and my courses, that anyone can do this. It's just that for the longest time, investing and investing concepts have been obfuscated or made seemingly more complicated than they really need to be. And that's what I found out in my journey. Initially, when I started out, we did not have internet. We did not have robo-advisors. We did not have free trading accounts, right? And all of this information wasn't out there, and it was so hard, so difficult to understand what was going on. I was doing stock screeners, I was doing fancy analysis, I was doing charting. I mean, I do all of that still. It was great to learn. But really, I lost so much money trying to figure out how to do this. What is the path to do it? And there's so many easier ways to get investing than what the road I took. And frankly, the number one way, and I'm sure you know this, people can get investing and they don't make this leap, is just to contribute to their workplace retirement accounts or benefit packages or employee stock purchase plans. That's the number one way an individual can start investing. And it's so funny because when I was, starting out, and I remember this, like I had a mentor that said, Jessica, what are you going to do with that first paycheck? And I'm like, I'm going to, I have a really nice apartment that I'm probably overpaying for. And I'm going to go out on Friday night and go have some drinks. And he's like, no. Like, how much are you going to put towards your 401k and the employee stock purchase plan? And I had no idea what they were. I just did it because he told me to. And funny enough, it wasn't until like years and years later that I even knew what I was putting money into.
Yeah.
So I think that's one of the number one ways people can be investing that they don't know about. They think, oh, I need to go through Robinhood, or oh, I need to go through a financial advisor. No, just contribute to your workplace plans.
Yeah, and that's a great place to start. I had a similar situation where, my folks, just a little background, I don't come from money, and that was one of the things that you look around sometimes and you see decisions that were made or not made in your own family, and they told me, hey, no matter whatever you do, don't do what we did. Put some money away for yourself from your very first paycheck. And I started investing when I was 22, right? So that was about 20 years ago. And I had no clue what I was doing. And, things were going down. It just so happened to be an interesting time in the markets. And I just kept doing it because I knew in the back of my mind, well, they told me to do this, and they, obviously mean well for me. And I know I need to retire someday. I don't really know what that looks like. I didn't really know. I think I was maybe using a target date fund or something at the time. Didn't really know what I was doing. But, the longer I did that, and this is all before I got into financial services, and come to find out one day, like, holy crap, I really set myself up for, a pretty nice future going forward that wouldn't have been possible otherwise if I didn't start then. So sometimes even before you feel like you really know what you're doing, taking action really is the first big step.
Absolutely. I completely agree. And it's funny how, it really was someone that said to us, look, this is something you should be doing. It wasn't the workplace that was explaining it to us. In fact, sometimes these workplaces make it more confusing than it needs to be as well. But really, just there are so many simple ways out there. And that's what I really wanted to get across with the Investing for Beginners course, is all the ways that you can put your monies to work, and sort of also analyzing your own risk tolerance. Because frankly, when you go to a financial advisor for the first time, or if you open up a robo-advisor account, they're asking you questions based on your risk tolerance to see what kind of assets to invest your monies into. And so even understanding what that questionnaire is asking is super important to your future. And let me chime in, if you don't mind, with an example of one of my women that I coach. She came to me later in life, 55, and very similar to your situation. She came to me and said, look, I'm afraid of money. Will you help me just look at my statements and tell me what I have? And I said, sure, no problem. I'm happy to do this with you. And so I sat down with her and I was looking at all the statements, and she's told me a story about how she used to be at a Fortune 500 company. And in her 30s, instead of participating in her 401k or the employee stock purchase plan, and this is 25 years ago, right? In her 30s, she was working here. She was too afraid to talk to her human resources about her benefits, and she just didn't do it. And instead, she went to a financial advisor. And in this situation, and I saw the annuity that he put her in, an insurance product, again, because of course, insurance products, if it is a insurance broker, they get a higher commission, as you saw with the example that you saw as well. And an annuity is this type of annuity that she invested in was for someone that had a very, very low risk tolerance.
So they put her in a fixed contract?
I'm not sure. Like it was, but the yielding of it, like it basically, there was no upside on it compared to the markets. And I was looking at this and I'm like, the markets are up significantly. How is this, at this value, at this valuation? So, but what the lesson of the story though is there is a tax on wealth for those that go into a financial advisor and say, I'm scared of losing money. Because when they take that risk assessment, there are questions to see, for example, if the market goes down, how would you feel? How would you react, right? It's asking you your risk tolerance, right? How you will behave in a market downturn, how risk averse you are. And the more fearful you are, an individual is, and the less they know about the stock market, the potential for that advisor to put them in a less risky asset, which in turn will not grow as significantly as a person that comes in and says, I understand the market, I understand that I'm young, put me in something a little bit more risky because I have the time to wait it out, right? If you're a young person and you come in there, you know what? The financial advisor is going to be like, okay, I'm not going to have to deal with questions from this person in down markets. They get it. They know it's long-term. I'm going to put them in some a little bit more riskier assets. Whereas if someone that is 30 years old and says, oh, I'm afraid of this, I don't want to lose any money, well then that same financial advisor might say, ooh, okay, we're going to put you in less risky assets, and that potentially won't grow as much as the person that goes in there with the confidence and understanding what's happening.
That is 100, as a financial advisor and CFP, that is 100% correct, everybody. So you need to if you need to hit the rewind button, go back and listen to the last, and don't mind if you can hear my daughter crying in the background. She's supposed to be napping right now, but my wife's in there. But go back and listen to that, and ignore the crying if you hear it. But that is absolutely 100% correct. In fact, the client that I alluded to from yesterday, once we got through talking about the other accounts that she had and whatnot, and she ended up getting signed up for her workplace retirement plan, she was the latter. She was the one that said, hey, look, in her case, she was in her mid to late 30s. I'm basically, technically she got started a while before that, but realistically, she was kind of, for the first time going to be putting some serious money into her workplace retirement plan. She was just getting started, and we went through actually a risk tolerance questionnaire, and that is exactly her, the way that she thought about it, which was, hey, if the market does this, what would you do? Well, nothing. I'm not retiring yet. I don't need this money yet. But there are people, like you mentioned on the former example, where if they, because let's just face it, it's a liability thing, right? We have to have errors and omissions insurance, right, as advisors. And so I think you called it the wealth tax, which was interesting to frame it that way. But I would agree with that, because you will, generally speaking, end up with less money at the end if you are quote unquote scared and you go into it that way, because the person on the other end is worried just as much about your money, if not more so, than their own licenses and their own credentials and their own record, and not getting a complaint because they came in and they talked to the advisor and they told them, hey, I don't want to lose money. And even if they went into a fairly conservative allocation, right, that has the potential to drop a little bit, let's say it wasn't strictly a fixed contract, all of a sudden now that client potentially could get upset later. That phone call could come in. They could file a complaint, and that's the last thing that anybody wants. And so that's a really excellent point, and I think everybody really needs to pay attention to that, because you need to understand essentially what you're getting into, but also the things that you say, how that could actually work to your detriment, accidentally so. But that does happen, and I've seen it.
And thank you so much, thank you so much for really chiming in on that from a financial advisor perspective. And I feel like education is so important, and understanding how finance works and investing works. I'm not a financial advisor. I don't want to invest people's money. My whole goal here is to educate individuals, mostly women, but I also have my workplace coaching, the FinIQ EDU, where I go into workplaces and actually educate employees, co-ed employees, based on this as well. And it's so interesting that a person with financial knowledge can perform and have more wealth than someone that doesn't. And it's bizarre, it's so interesting. But going back to this one story, if I may, going back to it, also, when you don't have confidence in your own knowledge base of finance, that also can lead to being taken advantage of, because frankly, it's your money and you want to question anyone that wants to help you with it, right? So whether it is a spouse, whether it is a family member, and even, potentially a financial advisor. So with this example that I was talking about, the financial advisor wasn't like you and didn't say, hey, you should be contributing to your 401k. You should be contributing to your employee stock purchase plan first, and when you have extra money, come to me. No, he didn't do that. He sold the annuity instead. And so being able to question is so powerful, and to be able to advocate for yourself. And that was really one of the reasons why I created HerFinIQ, was so to empower individuals to even have those conversations with their financial advisors and talk with them and really understand what's going on with their monies.
I agree. And it also makes for, at least in my opinion, a better interaction with us as your advisor, because you are more well informed, you have the ability to ask better questions, you have the ability to understand certain concepts, and sometimes from a strategic and a planning standpoint, it allows us to go a little bit deeper there as opposed to just going over really the basics if you have that part covered already. So yeah, I personally like it. And quite frankly, it keeps me on my toes when I have clients that are well-educated, well-informed, and they ask intelligent questions, because it allows our conversations to go deeper as opposed to more surface level. And I think a big part of it is all of us as individuals, just as consumers, as an individual investors, we kind of owe it to ourselves to at least try to have that baseline level of personal finance education, so that we know we might not have all the answers, and that's okay, but we can have an intelligent conversation. We know what questions to ask, and it just makes it, I think, a better experience for everybody.
Absolutely. And not only that, but understanding finances and understanding the different accounts and how they apply to your life stages and the buckets, right? Really being able to see the buckets on a holistic perspective. And what's interesting is that today I'm actually working on a lot of budgeting workshops, because everything comes down to your budget and allocation from your budget. So it's interesting because today I'm working on how much house, right? How much house should you be spending? What percentage of your income should you be spending on your house? And this is especially interesting right now because of how expensive it is to rent and how expensive home prices are right now. And so I find that, and maybe you find this as well, people are stretching themselves and beyond what they should be, and really to the detriment of their future wealth, so to say. So let me give you an example of this and why it kind of like brings full circle. You're like, Jessica, you're all over the place. But
no, this is great. This is good.
Let me go full circle on this one. So a person's budget, okay, just to back out, a person's budget should be 50% of their take-home pay. So what hits their bank account after their 401k contribution, post the employee stock purchase plan, post taxes. So this is your actual take-home pay. Okay, that's mistake number one that people sort of get hung up on when they're doing their math. So 50% should go to your needs, 30% should go to your wants, and 20% should go to your savings. And this is ultimately where you want to get to. Now, it can get adjusted depending on credit card debt, etc., or if you're going through a tough time, or if you just want to giddy up on savings, you can allocate more of your wants to savings. So those can be adjusted, but ultimately where you want to get to is 50% needs, 30% wants, and 20% savings. So when we think about building wealth, right, it really is a surplus, taking that surplus and putting it to work. But what happens if we don't have a surplus? What happens to our wealth when that surplus isn't created? And so the reason why I'm thinking in terms of this is because, say an individual is looking at houses, and where the top range of percentage of your take-home pay is 40%. That is the highest that your cost for shelter should be, okay? And if you think of it, your take-home pay is set. It is set. So if you are higher than that 40%, guess what? Your needs, your wants, your savings, those all go down in proportion. And the first thing to go is typically savings. And not only that, but if something goes wrong, so say you buy a house and the boiler goes, right?
Yep.
Well, then you are just one emergency away from not only not building wealth, but being in debt. And then that is hard to do. That is hard to get out of that situation. So building wealth really, just to a very basic level, starts with budgeting, and budgeting for surplus.
Yeah, I agree with that. I mean, the big three typically, right? Food, housing, transportation. And if you can get those right, or the majority of that right, I feel like it makes it a lot easier for everything else to fall into place for people.
Absolutely, absolutely. So I hope you don't mind me going off on that little tangent.
No,
But that's
not
something
at
that's
all. No, this is
it's right in my present mind today.
It's good, and it's going to be different for everybody. But the way that I always see things, and I get shit sometimes from people because they know, hey, you're a financial advisor, you guys do very well, you invest in real estate, like you know what you're doing. Why do you live in a quote unquote small house, right? It's like, why is your house so small? I was like, what are you talking about? Like, yeah, I could go buy the McMansion, but why? We don't need that. We're a family of 3 right now, right? So, we live in a very modest 1,600 square foot house, which I think is fine. And when I first was, getting into the housing thing, when I built the house or had the house built, it was one of those things where I wanted something that would meet my needs, but I wanted it as affordable as reasonably possible. And so naturally you would, and of course times were very different back then, but you'd want to spend as little as you reasonably could. And I'm not saying go buy a shack, but I'm also saying that there's a lot of people that might see or hear certain percentages and certain numbers. Maybe they have a particular job or income at the moment, and they're like, oh, well, if it's based on a percentage, and I'm not saying you're saying this, I'm just saying in general, people think this, that if it's based on a certain percentage, then this is what I can quote unquote afford. And oh, by the way, my real estate agent, who is incentivized by getting you to buy something bigger to generate a higher commission, and my mortgage broker, same thing typically, are going to nudge you to be on the other side of what otherwise might be your comfort zone, and maybe stretch for a little bit more and buy a little bit bigger of a house. And to Jessica's point, I think that's where people could potentially get into trouble, because it's the rest of their finances that are, basically there's a sacrifice there. And then, oh, by the way, what happens if that income stream dries up? What happens if that job goes away and maybe there's now another position, maybe that's potentially a lower paying job? So all of a sudden now the numbers skew even further. And, you could keep going down the rabbit hole with it, but I think for most people, housing, yes, for a lot of people right now is very unaffordable. The whole rent versus buy thing, we'll save that for another day. But I think we all still need to not stretch for the max as far as home ownership or even for renting, and live somewhere that's, clean, safe, affordable, functional, that meets your needs. But just because it's a certain percentage of your income and you could go more, and you could buy more or rent more. Doesn't necessarily mean that you should.
It's so interesting, this conversation, because all of a sudden I was just thinking about, moving. I'm originally from Pittsburgh, and I went to school in Boston, and I basically had enough money to live for 3 months. And I made this big leap of faith to go there. And I found myself living on the floor in a apartment with a bunch of girls, right?
Yeah.
So, because that is what fit my budget. That's what I had to do to get to the place that I wanted to get to. I couldn't afford furniture, but because my mother was an immigrant, she didn't believe in credit cards, right? So that was something that I'm actually very thankful for, because I always lived in my means, as opposed to, oh, I'm going to put this on my credit card so I can enjoy this life stage now. And the other day I was thanking myself. I was looking back and really thinking about everything that I went through, and I just thanked myself. I said, thank you for the struggle. Thank you for being frugal. Thank you for, doing what you needed to do, work those long hours, live within your means, because now I am in such an amazing place emotionally, physically, financially, all because I put in that hard work when I was young and flexible, didn't have the kids, and had lots of energy, right? So I also feel like these words to the young, especially that FOMO generation, the fear of missing out, the TikTok generation, like, put in the hard work while you're young and flexible so that when you get older, you can really take advantage of it.
100%. I couldn't agree more, because thinking back to how much I used to work, which at one time was insane. It was like 80 to 100 hours a week, 6 days a week. That's not sustainable. But you do what you got to do for a time. I did that when I was in my 20s. I could not do that now in my 40s. It just wouldn't work for many reasons, for whether it's family reasons, for whether it's physical, just you name it. But not that anybody wants to get burnt out, but you do what you got to do. And generally speaking, to your point, the time to do that is when you have the energy, and that's typically going to be when you're younger and maybe you don't have as many obligations versus later in life. You can really set yourself up for success in the future. So this is good.
Yeah, it's another, and it brings up the other thought of just life stages in general and budgeting for those life stages. And I know we mentioned young. I am nearing 50 myself, and I'm almost an empty nester, and I find myself having a time for a new career right now. And I was able to take the risk for this new career because I didn't have all the dependents. I had more time. And so just to individuals that are later in life, it doesn't have to be one career. You do have the time later in life to reinvent yourself and to take the risk on to reach your goals. So there's always the opportunity to achieve. And it isn't limited to younger or midlife, but really thinking about when you potentially have that opportunity to take advantage of a more risky situation. And frankly, when you're closer to retirement, it is scarier to do something risky. And you know that as a financial advisor, you reallocate portfolios to less risky assets when someone gets closer to retirement.
Yeah. And there's definitely, like you said, a life after the initial phase. Yesterday, there was a podcast that came out on Michael Kitces, who I follow. He's kind of, for those that are not aware, in my opinion, kind of like the Michael Jordan of financial services, and he does a lot with advisors in the advisor community. But he had a podcast, and he had this guest on named Michael Kay, who he did it on transitions to retirement after having done it yourself. And a lot of it was talking about how to help clients better navigate that transition. And there were some interesting examples that they went through on that show. And even the guest, was a retired financial advisor, and now he's a life coach. And what was next for him? And he tells a lot of stories about things he's seen and the people that he's worked with. And it's really, really interesting. But yeah, I mean, I think for a lot of people, there's an identity component to them in some way, shape, or form. Most of the time, I feel like it's people with a career. He gave an example of a doctor, and I forget exactly how he said it, but it was something to the effect of, he was a doctor, he retired, and then all of a sudden he was going back in. He was a surgeon, he was going back in, and when they had the conversation about why, he said, well, I wasn't a doctor anymore. I was a mister, and I didn't want to be a mister. And then the guest was like, well, I've been a mister my whole life, and it's not that bad. You know what I mean? So, it's just one of those things where sometimes our identity, I think, can get caught up in maybe an initial or main career when, to your point, there's a lot that can happen after that, and maybe, there's something else that we move on to. So tell us a little bit more about HerFinIQ and, for the listeners, as far as if they want to check you out. It looks like your website is www.herfiniq.com, and there's lots of resources on there. You got a blog, you got some courses there, which, by the way, to the listeners, Jessica's been so kind to give a 25% discount. So we will put the promo code in the show notes, and we'll put a link to her site. So anybody that wants to check out any of the courses, you guys will get 25% off, which thank you, by the way, for doing that. But tell us a little bit about, what they can find on the site and maybe the best way for folks to get started, depending on what stage they're at.
Thank you so much. So the investing quiz is really a great starting point to my courses. As I mentioned, I have 3 online self-directed courses. The first one is Before Investing, which talks about your financial ducks and the personal finance basics that you really want to get in a row before you start investing. And then we have Investing for Beginners. Again, as I mentioned, it's really about the how to get investing, what types of accounts, looking at your risk assessment. We even go through one of those sample financial advisor risk assessment questionnaires as well, and really get to the heart of what the financial advisor is asking in all those questions and the best way to answer it based on your life stages and your personal relationship with risk. So, and then the third course is Stocks and ETF Simplified. This is my wheelhouse, the stocks, the stock market sectors, the ETFs, really understanding how they work. I have a really fun identifying investment method that I created, which allows individuals to really look at their surroundings in terms of stocks. And so again, as you can imagine, just really fun ways to look at the markets, look at stocks, and look at ETFs. So the quiz, the investment quiz, really helps in a fun way. I want it to be like Cosmo style. I don't know if Cosmo even has these quizzes anymore, but I want it to be like a fun Cosmo style quiz. And as you said with that first question, yes, like getting to just, if you don't know the answer, it's okay. Someone else out there doesn't know it either, and we're going to get you there. So it's a fun questionnaire about which course would be the best start for you. So that is the quiz. I also, depending on when this is aired, I have a monthly meetup as well, and that is complimentary as well. It really is just the support session of my community. I had so many women in my programs and take my courses and say, hey, we miss you after it's done. Is there a way that we can create a community that helps us with our accountability, but also continue the investing conversation? So that's what the meetup is, and that is free to women anywhere that's interested in getting a leg up on their finances. And then I just launched a brand new free course. It's the intro course. It's the 3 stages of wealth. And that really looks at what are those 3 aspects of your wealth that you should be thinking about.
Awesome. Before I let you go, is there anything else that we didn't ask you about that you want to share with the listeners, or that you want to mention, or any closing thoughts?
This whole journey has been really amazing. And every conversation I have, every outreach I've had has really been amazing and has brought me opportunities or brought me into different spaces. And I don't know if you can tell, but I'm super approachable. So if you've really enjoyed this conversation, if you'd like more information, reach out to me on any social media. I'll get back to you personally. I'm just that type of person. And I look forward to hearing from you. I really do. I want to hear what you're thinking, what you're going through, and potentially how I can help you in your journey.
Awesome. All right. Well, Jessica Perrone, thank you very much for coming on the Real Talk Personal Finance podcast. And we will get your information linked with the promo code in the show notes for everybody. So thanks again, and we will talk to you soon.
Thank you so much for having me. This was so much fun.
Glad you enjoyed it.
Check the mic and make sure it sound right, boys.